Hello investors and future investors, welcome back to the channel. If you're new here, my name is Ben, and today we're diving deep into the world of dividend investing for beginners. If you want to learn how to make your money work for you, generate passive income, and build long-term wealth, then you're in the right place. So grab a notebook, sit back, and let's get started. Welcome to Investment Gains. Let's jump right into it. First things first, what exactly is dividend investing? Simply put, it's a strategy where you invest in stocks of companies that pay dividends. Dividends are a portion of a company's earnings that are paid out to shareholders, usually on a quarterly basis. This means you can earn a steady stream of income in addition to any potential stock price appreciation. Sounds interesting, right? Well, there's a lot more to it, so let's break it down. This video aims to educate you about dividend investing and all its intricacies. At the end of this video, you should not only know what dividends are, but you should be able to select your own dividend stocks based on your risk tolerance. What are dividends? To kick things off, let's talk about dividends in more detail. Dividends can come in two main forms: cash dividends and stock dividends. Cash dividends are the most common type. These are payouts made in cash to shareholders. For example, if you own 100 shares of a company that pays a $1 dividend per share annually, you'd receive $100 in dividends each year. Stock dividends, on the other hand, are paid out in additional shares of the company's stock. So, instead of receiving cash, you get more shares. This can be beneficial if you believe the company's stock will continue to grow in value. Companies usually pay dividends from their profits. However, not all companies pay dividends, as some prefer to reinvest their earnings back into the business for growth. This brings us to the next point. Why should you consider dividend investing? Why dividend investing? Dividend investing has several advantages that make it an attractive strategy, especially for beginners. Let's go through some key benefits. 1. Steady income stream. Dividends provide a reliable source of income, which can be especially useful for retirees or those looking to supplement their income. 2. Potential for capital appreciation. Besides the income, you can also benefit from the stock price appreciation over time. Your portfolio value goes up whenever your dividend stock price goes up. 3. Compounding effect. Reinvesting your dividends can lead to compounding returns. This means you can buy more shares with your dividends, which can then generate more dividends, creating a snowball effect. More on this later. 4. Lower volatility. Dividend-paying stocks tend to be less volatile than non-dividend-paying stocks, providing a more stable investment. 5. Inflation hedge. Dividends can grow over time, which helps combat inflation by increasing your income. Now that we know why dividend investing is beneficial, the next step is understanding how to get started. Let's talk about the key steps involved in building a dividend portfolio. And remember, if you're getting value thus far, remember to hit the like button and subscribe to the channel for more content like this. We appreciate your support more than you know. Getting started with dividend investing. Before you jump into dividend investing, it's crucial to have a clear plan. Here are the essential steps to get started. 1. Set your investment goals. Determine what you want to achieve with dividend investing. Are you looking for immediate income, long-term growth, or a combination of both? Your goals will shape your strategy. 2. Understand your risk tolerance. Assess how much risk you're willing to take. Dividend stocks are generally considered safer than growth stocks, but they still carry risks. 3. Choose a brokerage account. Select a brokerage that offers low fees, good research tools, and easy-to-use platforms. Some popular options include Vanguard, Fidelity, and Robinhood. Robinhood is the most popular due to it being more user-friendly for beginners and its low fees. To get started with a Robinhood brokerage account, please use the link in the description below. 4. Research dividend stocks. Look for companies with a strong history of paying and growing dividends. Focus on factors like dividend yield, payout ratio, and dividend growth rate. The dividend stocks in your portfolio will align with your maturity and risk tolerance. 5. Diversify your portfolio. Spread your investments across different sectors and industries to minimize risk. 6. Monitor and rebalance. Regularly check your portfolio and make adjustments as needed to stay on track with your goals. Now let's dive deeper into each of these steps, starting with setting your investment goals. Setting your investment goals. Setting clear investment goals is the foundation of any successful investment strategy. So ask yourself these questions. How much income do I need from dividends? How long can I invest my money? Do I want immediate income or am I focusing on long-term growth? For example, if you're looking for immediate income, you might focus on high-yield stocks. But if you're aiming for long-term growth, companies with a strong history of increasing their dividends might be more suitable. It's all about aligning your investments with your financial goals. We would love to know more about our investment gains community. Reach out to us in the comments below and let us know how much dividend income you would like to receive on a monthly basis. We also share our portfolio with our subscribers monthly, so like and subscribe for more. Understanding your risk tolerance. Next, let's talk about understanding your risk tolerance. Risk tolerance is your ability and willingness to endure declines in the value of your investments. It's influenced by factors like your financial situation, investment time horizon, and personal comfort level with risk. 1. Financial situation. Your current income, expenses, and emergency savings play a significant role in determining your risk tolerance. 2. Investment time horizon. The longer you can invest, the more risk you can generally afford to take, as you have time to recover from potential losses. 3. Personal comfort level. This is subjective. Some people are comfortable with volatility, while others prefer stability. Assessing your risk tolerance helps you choose the right dividend stocks and avoid panic during market downturns. Remember, the goal is to invest in a way that lets you sleep comfortably at night. Choosing a brokerage account. Choosing the right brokerage account is crucial for dividend investing. Here are some factors to consider when selecting a brokerage. 1. Fees and commissions. Look for brokers with low or no trading fees. 2. Account minimums. Some brokers require a minimum deposit to open an account. 3. Research tools. Good research tools can help you analyze dividend stocks. 4. User interface. An easy-to-use platform makes managing your investments simpler. 5. Customer service. Reliable customer support is essential if you encounter any issues. Some popular brokerage options include Vanguard, Fidelity, Robinhood, and Charles Schwab. Each has its pros and cons, so take your time to compare them and choose the one that fits your needs best. Robinhood has the first 3 traits mentioned above, and although their customer service is on point, it lacks user-friendliness for more mature individuals. Researching dividend stocks. Researching dividend stocks is perhaps the most important step in dividend investing. Here's a breakdown of what to look for. 1. Dividend yield. This is the annual dividend payment divided by the stock price. While a high yield is attractive, extremely high yields can be risky. Do not fall into the dividend yield trap. 2. Payout ratio. This is the percentage of earnings paid out as dividends. A lower payout ratio suggests the dividend is sustainable with a few exceptions. Real estate investment trusts are required by law to pay out most of their gains to investors. 3. Dividend growth rate. Look for companies with a history of increasing their dividends. This indicates a commitment to returning value to shareholders. 4. Earnings stability. Companies with stable earnings are more likely to maintain and grow their dividends. 5. Industry and company health. Invest in companies with strong financials and a competitive position in their industry. To find this information, you can look at a company's annual reports, earnings releases, and financial news. Websites like Yahoo Finance, Morningstar, and Seeking Alpha are also great resources for dividend stock research. Diversifying your portfolio. Diversification is a key principle of investing. It involves spreading your investments across different assets to reduce risk. For dividend investing, this means investing in a variety of sectors and industries. 1. Reduces risk. Diversification can help protect your portfolio from market volatility. 2. Stable returns. A diversified portfolio is more likely to provide consistent returns. 3. Exposure to growth. Different sectors perform well at different times, providing growth opportunities. Consider investing in sectors like technology, healthcare, consumer goods, and utilities. This way, if one sector underperforms, your entire portfolio isn't significantly impacted. Monitoring and rebalancing. Once you've built your dividend portfolio, it's important to regularly monitor and rebalance it. Here's how. 1. Review performance. Check your portfolio's performance periodically to ensure it's meeting your goals. 2. Reinvest dividends. Reinvesting dividends can help compound your returns over time. 3. Adjust allocations. If certain investments grow significantly, they might become too large a part of your portfolio. Rebalancing involves adjusting your allocations to maintain your desired risk level. 4. Stay informed. Keep up with news and developments related to your investments. Changes in company performance or market conditions can impact your portfolio. Use tools like portfolio trackers and management apps to stay on top of your investments. Regularly rebalancing ensures your portfolio remains aligned with your investment strategy. Next, we will go into dividend strategies. Some you may not have heard before: dividend tax consequences and some common pitfalls associated with dividend investing. Common dividend investing strategies. There are several strategies you can adopt when it comes to dividend investing. Let's explore some common ones. 1. Dividend growth investing focuses on companies with a history of consistently increasing their dividends. This strategy aims for both income and capital appreciation. 2. High-yield investing involves investing in companies with high dividend yields. While this can provide immediate income, it's important to assess the sustainability of the dividends. 3. Dividend reinvestment plans. These plans automatically reinvest your dividends to purchase more shares, enhancing the compounding effect. 4. Core and satellite. This approach combines a core of stable, dividend-paying stocks with a selection of higher-risk, higher-reward investments. 5. Income-focused. Primarily seeks to generate a steady income stream, often suitable for retirees or those needing immediate income. Choosing the right strategy depends on your individual goals and risk tolerance. It's often beneficial to blend different strategies to create a balanced approach. Tax implications of dividend investing. Before diving in, it's crucial to understand the tax implications of dividend investing. In many countries, dividends are subject to taxation, which can impact your net returns. 1. Qualified versus non-qualified dividends. Qualified dividends are taxed at a lower rate compared to non-qualified dividends. It's important to know how your dividends will be taxed. 2. Tax-advantaged accounts. Consider using tax-advantaged accounts like IRA or Roth IRA to invest in dividends. These accounts can offer tax benefits that enhance your returns. 3. Tax rates. Be aware of the tax rates on dividends in your country. Planning ahead can help you minimize your tax liability. 4. Record keeping. Keep detailed records of your dividend income for tax reporting purposes. Consulting with a tax advisor can provide personalized advice based on your financial situation. Understanding the tax implications helps you make more informed investment decisions. Common pitfalls to avoid. While dividend investing has many benefits, there are common pitfalls to watch out for. Let's go over some of the mistakes beginners should avoid. 1. Chasing high yields. High yields can be tempting, but they often come with higher risks. Focus on the sustainability of dividends. 2. Ignoring payout ratios. A high payout ratio might indicate that a company is paying out too much of its earnings as dividends, which could be unsustainable. 3. Lack of diversification. Concentrating your investments in a few stocks or sectors increases risk. Diversify to protect your portfolio. 4. Overlooking fees. High fees can erode your returns over time. Choose low-cost investment options when possible. 5. Not reinvesting dividends. Failing to reinvest dividends can slow the growth of your portfolio. Consider reinvesting to take advantage of compounding returns. Avoiding these common pitfalls can help you build a more robust and resilient dividend portfolio. Remember, successful investing requires patience, discipline, and continuous learning. Real-life examples and case studies. To bring everything together, let's look at some real-life examples and case studies of successful dividend investing. 1. Coca-Cola, KO. Coca-Cola has a long history of paying and increasing dividends. The company's stable earnings and global brand make it a popular choice for dividend investors. Full disclosure, Coca-Cola is part of my dividend portfolio. 2. Johnson & Johnson, J&J. Known for its diversified business model and consistent dividend growth, Johnson & Johnson is a staple in many dividend portfolios. 3. AT&T. While it offers a high dividend yield, AT&T's financial challenges highlight the importance of assessing dividend sustainability. AT&T used to be part of my dividend portfolio because of its consistent dividends. However, I had to drop it from my portfolio because of its stock value depreciation. The stock price keeps falling over the years. 4. Procter & Gamble, PG. With a strong history of dividend growth and a wide range of consumer products, Procter & Gamble is another solid choice for dividend investors. 5. Here are 2 more stocks in my dividend portfolio for your review. Altria Group, ticker MEO, and Main Street Capital, ticker MAIN. By studying these examples, you can gain insights into what makes a successful dividend stock. Look for companies with strong fundamentals, a commitment to returning value to shareholders, and a track record of stability. Conclusion. To wrap things up, dividend investing can be a powerful strategy for generating passive income and building long-term wealth. By understanding dividends, setting clear goals, researching stocks, and avoiding common pitfalls, you can create a successful dividend portfolio. Remember, 1. Start with clear goals and a solid plan. 2. Do thorough research on dividend stocks. 3. Diversify your portfolio to manage risk. 4. Monitor and rebalance your investments regularly. 5. Stay informed and keep learning. Thanks for watching. You have chosen to take the next step to achieve financial freedom. If you found this video helpful, please give it a thumbs up and share it with your friends. Don't forget to subscribe for more financial tips and strategies. And if you have any questions or topics you'd like us to cover, leave a comment below. For help on how to create and grow your dividend portfolio, feel free to email us using the email in the description. We are here to assist you. Thanks again for watching and keep pushing your investments. Don't forget to check out our other videos for more tips on personal finance and investments. See you in the next video.